Hey traders, Jason here from Leavitt Brothers. Hope you're well. So in this video, I'm going to talk about what's on the other side of this bear market. Now, technically, we're not in a bear market because the market's not down 20%. But the way stocks are acting, the number of stocks that are down 50, 60, 70, 80% is so big. The way the price action is playing out, the market might not technically be in a bear market, but it's acting like it's in a bear market. But I don't want you to get discouraged, because what tends to happen after a bear market is a huge bull run. Okay, so I want to show you some stats which talk about what tends to happen after big corrections. Okay, so if you're like frustrated right now, the market's going down, a lot of stocks posting big losses, stocks pop, but they only last a couple days before getting pushed back down. Easy to get frustrated right now. So I'm mostly talking to you. I want you to know that what's on the other side of this bear market is a big, giant bull market that's going to provide many opportunities to make a lot of money. You just have to have your head on straight and not be overly discouraged, because otherwise you probably won't participate in that bull market. And of course, you also have to have some money ready to deploy. So let's go through some stats here. So here are some numbers. This is from LPL Research. So this is every single correction that was between 10 and 15% between 1980 and today. Okay, so here they are. Those are all the 10 to 15% corrections. The average is, right there in the middle at 12. But look here. 1 year after the lows are in place, the market is up every single time except once. There was one down year here. That was the dot-com bubble. Otherwise, the market was up every single year, and the average and median gain of the market was almost 22%. Okay, so 10 to 15% correction. A year later, after the bottom, the market's up in almost every case, with the average gain being 22%. In 2 years after the low, again, the market is up almost every year, and this time the average and median gain are like 37, 47%. Okay, and this is for the S&P. If the S&P is up 35, 36, 37%, leading stocks are going to be up 100%, 200%. Okay, so this is encouraging. Okay, we have a correction that we're undergoing right now, but when a bottom is in place, there are really high odds that not only is the market going to be up 1 year from now and 2 years from now, but it's going to be up big. Next up, this is a blurry chart. I get it, so I'll walk you through it anyways. So the last chart was only corrections that were 10 to 15%. This is all corrections since 1980. Okay, so you got like 1980 here, another one in 1980, 1981, all the way to 2020. So here are the corrections, all corrections since 1980. Okay, they averaged right here 18.8%. 1 year after a low is established, whoa, what happened there? 1 year after a low is established, we have a 90% of the time the market has been up, and you can see gains are lots of green here. There's a couple down years, but lots of green, and the average median gain is 23% and 25%. Okay, so considering all corrections, no matter how big, a year after the market lows are put in place, 90% of them are up more than 20%. In 2 years after a low is in place, again, lots of green, average median gain 37%, 45%. Okay, so once again, big drawdown, big correction. Once a bottom's in place, there are very high odds that not only do we have an up market a year and two later, but the up market is going to be, the up is going to be up a lot. And again, if you have the markets up 35, 36%, leading stocks are going to double or triple. Next up. So here are the Dow quarterly returns from 1896 through 2017. Okay, based on the presidential cycle. So presidential cycle, it's 4 years, 4 quarters per year. So there should be 16 bars here. Year 2 of a presidential cycle, which is what we're in, tends to be the weakest period during the 4-year cycle. So right now we're here. Right now we're in year 2, quarter number 1. So we're in a period, we're at the, not only at the in a period, but we're at the beginning of a period that tends to be very weak. It tends to be very weak. Quarter 1, quarter 2, and quarter 3 tend to be weak. But following that weakness, following the tendency for a midterm year pullback correction, you get 3 consecutive quarters of big gains. Okay, so this is just kind of put things in perspective. We are right here. Okay, so even with interest rates probably going up at some point in time, even with the war out in Ukraine, even with inflation, we tend to be we tend to be weak at this time of year anyways. So now we have a confluence of a couple of things. I just want to put this in perspective that we tend to be weak right now anyways. But once we get through that weakness, we tend to have 3 big quarters in a row. Now, to put some numbers behind these bars, this is a chart that I've shown a few times in other videos. Again, LPL research. These are all midterm year corrections since 1950. Okay, so 1950 was a midterm year, 54 was a midterm year, 58 was a midterm year. These are your midterm year corrections. Okay, you can see, pretty decent corrections. The average is about 17%. So going back all the way to 1950, we have averaged a 17% correction during this year. But 1 year after the low is in place, we have a lot of big gains. The average median gain, 32, 33%. Only once, if you look at these numbers carefully, only once right here in 2014 was the gain less than 10%. There's another small one here, 11%, but most of these are, you look at this and it's like, 31, 43, 32, 33, 45, 30, 34, 58, 40, huge gains, okay? So there's definitely a tendency for a sizable midterm year correction, but once the low is in place, there are high odds that not only does the market move up a year later, but it actually posts a huge gain a year later. And again, if the S&P is going to go 32%, leading stocks are going to double or triple. Here we have the year-to-year gains and losses of the market. Okay, going back to 1930. Okay, so green is positive, red is negative. So I want to point some things out. Since, here's like 2020, so here is like 1975 here. So in the last 45 years, only once has the market posted back-to-back losses. Once in like 45 years, the market has posted back-to-back losses. Every time it's been down, it's always bounced back the next year. Okay. If you go back even further, okay, here is approximately the end of World War II. Okay, since the end of World War II, here are all the down years. Only twice, here in 2000, 2001, 2002, and mid-70s has the market dropped in consecutive years. Okay, so that's encouraging. Even if the market's down this year, odds are it's going to bounce back next year. Okay, that's just what history says. Okay, over the last, whatever it is, do the math, 75 years, the market has only dropped in consecutive years twice. Okay, another thing to point out from there is the tendency for the market is just to bounce back after a decent down year. So here we have a down year here, and we have it followed by a big up year. Down year here, followed by a big up year. Down year here, followed by a big up year. Down year here, followed by a big up year. Down year here, followed by a flat year, but then 2 consecutive up years. And it goes on and on. Every time we have a down year here, flat year, and then 2 big up years. Down year here, 2 big up years. Okay, so just want to point out that 1, it's rare for the market to post back-to-back down years, and 2, even if it does post back-to-back down years, the market tends to either bounce back with a huge up year, or it'll trade flat for a year and then have a huge up year. Okay, so don't be afraid of a down year. Even if we get a down year right over here, that's fine. What that means is we're going to have a couple big candles over here. Okay, if whether midterm year election tends to be weak, we're already in correction mode. If we have a down year, to me that's fine. Like, to me, the lower the market goes, the better, because the lower the market goes, then we're going to get like some back-to-back, huge up years. Okay, so if I were to summarize all this, I'd say don't fear a down year. The market has always bounced back. Okay, always. Individual stocks don't always bounce back, but the market bounces back. It's normal to have a down period during a midterm election year. So again, don't fear it. Instead, get excited about the opportunities that will be presented when the market bottoms. Even if we do have a down year, odds favor a flat year followed by a huge up year or just a huge up year. So either way, the market will bounce back. But you have to have your head on straight and you have to have money in your account to deploy. Okay, so play good defense right now. If you're mentally just completely out of whack because the market's moving down, you're going to have a hard time going long when the market bottoms. Okay, or you'll go long, but you'll go long with small positions, and then you'll make some money, but you won't make a lot of money. You got to make sure your head's on straight and you have money in your account. And I should say one more thing, and that is that in all these cases, there's like one little asterisk, and that is after the market bottoms. Okay, after the market bottoms, whether it's midterm year tendency to move down or just a correction any other year. Yes, a year later, the market is probably going to be up. Yes, 2 years later, the market's going to be up. Not only up, but up big. But that's measured from the low. It's measured after the market has bottomed. And we don't know when the bottom's going to be. The bottom might not be for another few more months. Okay, so if you guess a bottom early, then you're in trouble because you're going to sit in a lot of losses. So don't fear a downtrend. Don't fear a bear market. The market tends to do extremely well after a low is in place. But there's a key there. It has to be after a low is in place. Okay, hope you got something out of this. Come check us out at Leavitt Brothers, where we provide market analysis and trading ideas. You can also check out my Masterclass there. You want to contact me, there's my email. Hook up with me on Twitter, whatever floats your boat. All right, hope you got something out of this. I'll see you next time. Thanks for listening.